We consider middle market to be transactions valued below $250 million. And we look at the health of the market based on the number of transactions that happen and the data we can pull on how valuations in general for companies in that category across a whole range of industries are moving. And I think we've been through a period of about 4 to 6 quarters that were particularly slow and off considerably from the quarters that were all-time highs in 2021 and the first half of 2022. But I think the interesting new information we've gotten is that I think that's starting to turn a little bit. Through the first half of the year, we're off about 5 to 10% in the number of deals that happened last year, which were off 10 to 15% from the year prior to that. But Q2 is looking to be about flat with Q2 from 23. The banking market is still quite tricky. High rates make it expensive to borrow for leverage lending, but a lot of banks just simply are a little overcautious and not lending into the M&A markets. That's also contributed to the slow time. But all of the other associated data points, levels of escrows, holdbacks, all those types of things are also starting to revert back to more seller favorable terms. I think we expect to see Q4 and 2025 to be a much busier time.
According to the Exit Planning Institute, 50% of businesses fail because of unintended consequences, not being prepared. And that is being prepared for the 5 Ds, typically, which is death, disability, divorce, distress, or disagreement. So having a proper contingency plan in place and working with a really good M&A corporate attorney like Shannon to have those operating agreements in place, to have the necessary systems in place and operating agreements in writing, having your buy-sell agreements in order, having your key person insurance in order to de-risk. So a lot of what we talk about on this to be prepared for one of the 5 Ds is de-risking your business and going through each of the steps needed to be prepared for any unforeseen events like that.
How far in advance should people all be doing these things? And that's like the easiest question anybody could ask all night, because the answer, no matter how much you've done and where you are, is always, you should have started yesterday. You can never do too much preparation. You've never heard anybody close a deal and be happy with it and say, boy, I wish I'd done less preparation. You never will hear anybody say that. If you knew then what you now know, what would you do differently? And they laugh. They'll say, my God, well, first of all, thank God we just did this. This is awesome. I'm excited. All the things I can do now. The reason you need to do this preparation with people who do it, eat, sleep, breathe it 10 times a day is every buyer, whether they're a corporate buyer, whether they're a private equity buyer, whether they're a competitor. Honestly, if you start doing something with a family member to try and transition it to them, they're going to have advisors that are going to do this the right way. These are smart people. You're not going to slip anything by them. You can't beat the market. You can't time the market. The reason you get paid a multiple is because people are looking for the future cash flows of what you're doing, and their best approximation of that is what you've done in the past. If you try to carve all the meat off the bone, these buyers are smart. They do this for a living. They buy companies low, they sell companies high. So timing the market, just forget about it. You need to prepare and be able to communicate the right value proposition to the right buyers, and it's different. You might have 6 different value propositions to different buckets of buyers. And, unless you can get them to compete against one another and compete against themselves, because they don't know whether they're the high bidder when you run through this type of we don't use the word auction, by the way, because I think people get a little anxious when they hear that, but we call it, we've got a brand of, we call that done rush, 2-stage controlled sale. Sounds a little nicer, a little gentler.
Owner readiness is aligning the 3 legs of the stool, their business goals with their personal goals, with their life after the business goals, life after the business meeting. The owner having an understanding and a thought process already in place well in advance of the sale of their next act, what their next stage of life might look like. Actually, a lot of deals end up falling apart at the 11th hour for that reason, where the owner gets cold feet because they haven't actually thought that through. And the example I gave with the client who the valuation came back less than what the client thought the company was worth, and actually wasn't going to be enough. There was this wealth gap. And we identify that wealth gap and then can take steps toward increasing value. to where it would need to sell for to meet that client's goals.
You're never going to get a higher price after the LOI is signed. Buyers are looking for holes in your business, weaknesses in your business. This is the question that Tom's alluded to. What are the things as a seller that you should be concerned with that could adversely affect your deal? Classification of employees, independent contractors versus W-2s. That's a hot button issue that always comes up. If you have intellectual property in your business, have you adequately protected it so that the business owns it and the intellectual property doesn't reside in you as the owner of the business or your employee workforce? Environmental. Do you operate a business that has discharge? Are you operating your business on a site that previously was operated by somebody that has discharge? You, as a seller, need to do effectively a pre-deal examination of your company. If you want to understand what the weaknesses are of your business, try to sell it and go through that examination. If you've got a team of advisors, they can walk you through that process and you can preemptively address some of those issues, but you can't wait to react to those issues in response to a buyer.
I think the other thing I want to talk about is when he talks about the letter of intent, the LOI, is going to be the deal structure is in there. And it's going to talk about whether this is an asset deal, whether it's a stock deal, whether there'll be working capital adjustments, whether there'll be earnouts. They'll have a potential price in there, but you don't necessarily know how those components are going to shake out. And it's really important to think about that from the perspective of what kind of entity do you have. And this is where a good tax advisor or someone can come in and tax lawyers. Because, for example, if you have a pass-through entity, if you're an LLC or an LLP, you might actually have zero basis in that company. And so everything that you potentially sell, depending upon how the deal is structured, could be taxable.
And I think no letter of intent you've ever seen is worth anything at all to you unless you are convinced it can get closed. And 100% of that confidence level comes from your level of preparation, not what you think is necessary, but what these buyers are going to have their armies of. You're going to have 30 advisors from the buyer that are in your data room scrubbing over thousands of documents, each one of them looking to rationalize their six-figure fee. And they do that by suggesting the price should be carved back or changed or done in a certain way that is going to bring down your proceeds. You need to have advisors that are going toe-to-toe with these big advisors that the buyer comes at, and the LOI needs to be something. If you pick an LOI and you're not sure it can get closed, it's worthless to you.
We talked about the private equity fund, the venture fund. Those are professional investors that go out and raise money as a general partner from limited partners to create the fund, and then they deploy that capital in the form of either investments or acquisitions. That's a PE buyer. Sometimes they're referred to as a financial sponsor. Contrast that with a corporate buyer, which is typically someone that's in the same industry as the target. They can be direct competitors. They can be tangentially related to you as a company, but they tend to be in it for the long haul as an entity. They typically have strong balance sheets and they have a long-term horizon. So within that context of those two examples, a PE buyer will buy your company, and because they're a professional investor, they have an internal clock that says we need to do what we need to do with this company over the next 3 to 5 years, and then we need to flip it because we as the general partner have a fiduciary obligation to our LPs to distribute the proceeds of their investment from what we did with this company. A corporate buyer can have a much longer time frame as to how long they have to turn your company into what they want to turn it into. And so you may have more flexibility in terms of how you structure that deal relative to a PE deal.
The holy grail of all this is, and I would tell you 95% of the buyers that have won the processes since we set up our firm more than 15 years ago are a hybrid of the two. They're a corporate company that's already owned by a private equity firm, usually a bigger one that would be interested to buy you as a platform, and they're going to tuck you in with the savings and synergies, and they have that clock on their head weighing on them to do more deals and eventually turn that money back to their investors. If you can get one of those things, that's great. You'll get a better price than somebody that doesn't have either. If you can get them both, they'll outbid the people that don't have them 95% of the time.